The real reason tech stocks are becoming more volatile in 2026 isn't just about interest rates, inflation, or even artificial intelligence hype. It's something deeper, more structural, and far more important for investors to understand. On the surface, it may look like the same old story: markets reacting to economic data, earnings reports, or geopolitical tensions. But underneath, the mechanics of the market itself have changed, and those changes are amplifying every move, every headline, and every shift in sentiment. To start, one of the biggest drivers of volatility right now is the sheer dominance of a handful of mega-cap tech companies. Over the past decade, a small group of tech giants has come to represent an outsized portion of major stock indices. This means when just one or two of these companies move, they can drag the entire market with them. In 2026, this concentration has reached a point where the market is no longer broadly diversified. It's heavily dependent on a few key players. So when investors get nervous about one company's earnings or growth outlook, the ripple effects are immediate and intense. Another major factor is the rise of algorithmic and AI-driven trading. Today, a huge percentage of trades are executed not by humans, but by machines reacting to data in milliseconds. These systems are designed to detect patterns, news sentiment, and even subtle shifts in language from earnings calls. While this increases efficiency, it also creates a feedback loop. When one algorithm starts selling based on a signal, others often follow, amplifying the move. This is why we're seeing sharper spikes and faster drops than ever before, because machines don't hesitate and they don't second guess. At the same time, retail investors are playing a bigger role than ever. Thanks to easy-to-use trading apps and access to real-time information, millions of individual investors are actively trading tech stocks. But unlike institutional investors, retail traders often react emotionally. They chase momentum when prices are rising and panic when prices fall. Social media trends, viral posts, and online communities can drive massive inflows or outflows in a matter of hours. This adds another layer of unpredictability, turning what used to be gradual price movements into sudden surges or crashes. Then there's the impact of interest rates, which still plays a critical role, but in a more complex way than before. Tech stocks are particularly sensitive to interest rates because their valuations are often based on future growth. When rates rise, the present value of those future earnings decreases, making these stocks less attractive. In 2026, interest rates have been fluctuating more frequently due to uncertain economic conditions, central bank policies, and global instability. This constant adjustment creates ongoing pressure on tech valuations, causing frequent repricing and increased volatility. But perhaps the most overlooked reason for this volatility is the uncertainty surrounding artificial intelligence itself. AI is no longer just a buzzword, it's a transformative force reshaping entire industries. However, the market is still trying to figure out who the real winners will be. Every tech company is racing to position itself as an AI leader, but not all of them will succeed. This creates a situation where expectations are incredibly high, but outcomes are uncertain. As a result, even small updates, like a product announcement or a shift in strategy, can trigger massive swings in stock prices. Earnings reports, which were once predictable catalysts, have now become major volatility events. In the past, companies would guide expectations carefully, and markets would react within a relatively narrow range. But today, expectations are so elevated that even strong results can lead to sharp declines if they don't exceed projections by a wide enough margin. On the flip side, a slight beat combined with optimistic future guidance can send stocks soaring. This all-or-nothing reaction pattern is a clear sign of how fragile and reactive the market has become. Liquidity is another hidden factor contributing to the chaos. While markets may appear deep and stable, actual liquidity can disappear quickly during times of stress. When large investors try to exit positions all at once, there aren't always enough buyers at current prices. This leads to rapid price drops, which can trigger stop-loss orders and margin calls, accelerating the decline even further. In 2026, with so much capital concentrated in tech, these liquidity shocks are happening more frequently and with greater intensity. Global factors are also playing a bigger role than ever before. Tech companies are deeply interconnected with international supply chains, regulations, and markets. Political tensions, trade restrictions, and regulatory crackdowns in different parts of the world can have immediate impacts on tech stocks. For example, a new data privacy law or a restriction on semiconductor exports can instantly change the outlook for an entire sector. This global interconnectedness means that volatility is no longer driven solely by domestic factors. It's influenced by events happening across the world. Another important piece of the puzzle is the shift in investor mindset. Over the past few years, the market has moved from a growth at all costs mentality to a more cautious, profitability-focused approach. Investors are no longer willing to blindly fund ambitious tech projects without clear returns. This shift has created tension within the market as companies try to balance innovation with financial discipline. Any sign that a company is overspending or failing to deliver results can lead to sharp sell-offs, while evidence of strong execution can drive rapid gains. Options trading is also contributing to the increased volatility. More investors are using options to speculate on short-term price movements, especially in tech stocks. This creates additional pressure on the underlying stocks as market makers adjust their positions to hedge risk. This process, known as gamma hedging, can amplify price movements in both directions. When stocks start moving, these hedging activities can push them even further, creating a snowball effect that leads to extreme volatility. And finally, there's the psychological factor. Markets in 2026 are driven as much by perception as by reality. Fear and greed are amplified by constant access to information, breaking news alerts, and real-time price updates. Investors are more connected than ever, but also more reactive. This creates an environment where sentiment can shift instantly, and when it does, the market moves with it, often in exaggerated ways. So when you put all of this together, market concentration, algorithmic trading, retail participation, interest rate sensitivity, AI uncertainty, earnings pressure, liquidity risks, global influences, shifting investor expectations, options activity, and psychological dynamics, you get a market that is inherently more volatile than ever before. It's not just one factor causing these swings, it's the interaction of all of them at once. The key takeaway is that this volatility isn't temporary, it's structural, it's built into the modern market. And for investors, that means adapting to a new reality. Instead of expecting stability, you have to be prepared for rapid changes. Instead of reacting emotionally, you need a clear strategy. Because in a market like this, the biggest risk isn't volatility itself, it's not understanding what's driving it.